The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Call now, toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, Larry Pesavento.
Okay, folks, we're back here at TFNN today, and we're having a little rally in markets after we broke a 87-year record this past week when we had 4 down days in a row. That broke the streak that it held for, I believe, I don't know how many, a couple of years, but that had lasted since 1928. And now we finished the 5th down day yesterday, and we're in the midst of a really good rally today, which I would expect to continue to see. We've had a rally that started first in Germany, and I posted the German DAX chart up there also, and you can see it's due to go up about another 100 points or so to complete the ABCD pattern that we'll be completing in the S&P 500 up around the 2040 level, which was where it broke down from. This is going to be the real key, from my opinion, of where we're going, because we stopped exactly at the 786 retracement in the Dow Jones Industrial Average yesterday. We stopped exactly at the 786 retracement in the S&P 500. We went a little below it in the NASDAQ. I haven't checked the IWM yet, but we probably should, because that one had been the strongest during the rally, because we went up and were able to make new highs in that. So we'll take a quick look at that one and see what it did yesterday. Yes, it stopped exactly at the 786 also. So that's another really strong indication that we'll get this pretty good rally here, and we'll see what happens. If it's really poor, in other words, the rally is going to be really, really short-lived. It'll only rally a day or two, like today and tomorrow, and then start down again. But I believe anytime we go below the low we made yesterday, that's going to be a really significant move, because it's so close to the low from December 16th, which was the monster low that we had, the largest up day in the Dow that we'd had in several years. It took the NYSE to almost new highs. It did not make a new high. The New York Stock Exchange Index high is still the high in early July. We made a lower high in September, a lower high in December. Some of the indices, of course, we mentioned many times here, did make marginal new highs, but nothing really significant. The overall stock market, of course, is measured by the NYSE, which really is the broad market, has not really completed. It's completed 3 major tops up in here, which is a triple top, but usually quite bearish, but we'll have to wait and see, what's going on from that level. Much of the news today was on Apple, and I thought it was very interesting today. One of the announcers for Apple, he works for one of the big Wall Street firms. His name was Walter Piecyk. I've mentioned him many times before. His name is very familiar to me because he followed Qualcomm when Qualcomm was going nuts back in 2000, and he came on one day. It closed at 650, and I had shorted 500 shares of that stuff for the group that I was trading for at the time, which wasn't a lot. But it was due to be $100 a share higher, because he gave it a price objective of $1,000 a share, and it was trading at 650. Back in those days, it could have gone to 1,000, because stocks would move 30%. During that dot-com bubble, that was near the end of the year. It was in December. I don't remember exactly what. It must have been 99, or yeah, it must have been 99. And I called my trading. He was my supervisor. I was trading for some Saudis, and I told him, I said, look, I got stuck here in this Qualcomm. It's open between $70 and $100 higher, and I sold it right near the high, backed off a little bit, but I was now in a position where we didn't have overnight markets or anything like that. But anyway, the loss would have been $50,000, which was not a big deal for us because we had a good year. But what was funny is the stock opened at 720, had a range between 720 and 680, and it went from there over the next few months, all the way back to $300 a share, I believe, as the market started to fall apart. So just because these people, mention these things would be something to look at. I was really surprised to see this guy back in the business because he got into some problems. I don't remember exactly what it was. I remember his name because of that Qualcomm incident, but he's now back and he's following Apple for this company on Wall Street. So he's quite bullish on Apple, and it certainly looks like a wonderful product. I think that Apple has a chance to go drop 50% from here, but that's just the way it looks. I'm looking at the same chart, same type of pattern that we had back in, a year and a half ago when Apple was 703, and then of course it split 7-1. So we're trading it around that same price, around $700, $720. It's at the same level, whether it's going to be that or not. The years ending in 5 have a high probability of closing higher for the year, but again, remember there's only 20 of those each decade, so you don't get very many samples with this thing. So you got to keep in mind to follow the patterns, and those will be the ones that will, lead you to the promised land. So as long as we can hold these lows that we made yesterday, it still looks like we have a pretty good chance for a pretty significant bottom that we looked at. I was not able to listen to either Steve or Basil's show today because I just got back to sunny Arizona. We're having a little bit of a change in temperature from where we've been these last few months because we left Philadelphia at I think 12 degrees and snowing, and here we are in 70-degree weather, and it's really, really quite nice. But it's been very cold here in Arizona over the past few months. It's been so long since we've been home the past few weeks that we've had a little bit of a cold spell. Now, I wanted to show the VIX index because it's done a really good job at hitting the bottoms. And yesterday's high, believe it or not, if you follow these ratios that we look at, and this one is going to be looking at the, oh dear, I got the wrong one here, I'm afraid. Just give me 1 second. I think I punched the wrong chart in. I put in the Dow Jones chart. Give me a second here, and we'll see if we can get it right. There, I think, there we go. That should be it. We should have the VIX. Oh, I guess not. Let me try it one more time. Can someone tell me in the room whether I hit the right button or not? Because I'm trying to punch in the VIX index. Okay, now I'm going to get it right this time. 1 out of 3, and then we will. That should do it. We should get the VIX index in here. We on the sell-off that we had in late December, we went down to test the 786 retracement, making a higher high. And then the high we made yesterday was an exact 786 to the exact tick at 2281. And now what we should be looking at is another pullback down here, maybe to this 16 level if the market can hold up here. The market has done really significant damage, folks, I think. And the reason why, it's not so much the technical damage, it's the emotional damage, because the probabilities of a up days, the last days of December and early January have been negated, and that's that makes people think, and I think that's going to be the thing that really makes it look what's going to happen. Now, we made a really significant bottom yesterday at that 786. There's no question about that. In my mind, because of the way that came off of that number, the fact that the VIX hit it exactly, but that could be just very, very temporary. We have to, keep our pulse on this because, this market's been very, very bullish for a long time, and you certainly don't want to get caught into, selling weakness here when the market could be going a lot higher. And selling weakness is not what pattern recognition is all about. It's more about trying to find the patterns that line up with whether it's a buy or a sell. And right now, as of yesterday, we're in a buy mode in stocks because hitting those ratios spot on pretty much tells you, exactly, where you really are. Now, I do want to bring in the New York Stock Exchange Index, and hopefully we can get this updated and everybody can see it. Boy, I've been gone so long, these charts, I can't believe where they are now. The S&P, the New York Stock Exchange Index also stopped at the exact level yesterday, and I wanted to show you that if I can. There we go, and it'll show that the divergence that we've had in the New York Stock Exchange Index came in, right at the time that the Dow hit the number, and also the Let me see if I get this right. Okay, let's hope that the New York Stock Exchange Index is working. I can't believe it's been 2 months since I've used this computer because it's these large screens. I'm not used to manipulating them around. These 42-inch screens are just too big. Folks, if you ever have to buy a screen, for your trading and stuff, don't go any bigger than 32 inches is my suggestion, because 42 inches is really too large. That gives you a suntan for one thing. I make these things turn off at 15 minutes, so I'm not watching them very much. But they're fun to look at the big charts, but they're too bright, and it also makes it it's pretty good. So I think something around around that level, somewhere around 30 inches is pretty good. 24. I remember I bought my first 21-inch monitor at Comdex back in '91. This is when everybody was using 14 inches on their monitors, and I paid $3,300 for that monitor. And it lasted me 20 years. And my neighbor, who I gave it to, still has it and is still using it. And can you imagine that? That's a long time. And that's 25 years ago, and yet it's still working. Never been repaired, and still going strong. So these things have a pretty good life, I guess, which is, usually pretty good. Okay, now the first question that we had from one of our folks at TFNN is the Apple. And I'm going to put the Apple chart up here. We'll take a quick look at it here. And then we'll also take a look at Tesla. We've had some interest in Tesla because Tesla has a very interesting pattern that is really good here. Hold on a second, and I want to fix this here with Apple, and then we will be ready to go here. Okay. Dear, 1 second. I have to hit. There we go. We just made a nice pattern. In Apple on this low we had yesterday. We came right down to a 61% retracement in Apple, so we are in a buy mode. Dear God. Okay, I hope this is it. We are in a buy mode in Apple. It hit the 61% retracement down there at 105 and change, 104 and change. Yesterday we rallied a couple dollars from there. If this is true to form, we should rally. The last rally went from 105 to 114. That's $9. So we should go from 104, $9. It should take us up to around the 112, 113 level in Apple. Apple should not get higher than 112, 113 if it's bearish. If we look at Apple on the long term, I had to put this chart in here. This is to show you the fact that this chart has not been. This one's a funny one. You got to look at this one. I will be back right after. Stock's rallying strongly, and we'll be back right after this message.
How would you feel if you had a powerful decision-making tool that has the ability to find high-probability trading opportunities across multiple time frames in equities, currencies, and futures? Search no more. Take advantage of the best trade with the TAS Profile Scanner. Trade with confidence and clarity while using the software that thousands of institutional traders rely on to help them make the best and most accurate decisions. Scan over 1,000 equities, currencies, and futures instruments for high-probability trading setups utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time, for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. Subscribers will also gain access to the December 9th workshop with John Logan. There's no obligation to pay anything. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, the Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of the Art of Timing the Trade Charts today by visiting TFNN.com.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Technomental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Okay, folks, we're going to change gears here and take a look at the gold-silver index, the XAU. Several months ago, we bottomed back in November. We've now had our third lower high here, which is let's try that again, Larry. Our third lower low. Larry, we're going to try it one more time, Larry, one little bit at a time. We are having our third higher bottom. So this market has started to move up, and as you can see, we're heading to an ABCD pattern up about another $4 or $5 in this gold and silver index. It's still bearish, but at least it started to turn. This is a good thing that we've been watching. So we've got some major support. The question is whether it's going to be going higher or not from now. But right now it looks like it's still in a rally mode, and that's what we're taking a look at. Now I wanted to take a look at gold and silver together because they run in tandem most of the time, and we'll take a look at those, and you'll see that we have the same situation occurring here that we do in the XAU itself. What's interesting about this, the divergence between silver and gold is really unique right now because it's hitting these numbers just spot on. If you'll take a look at this chart that I've posted into Tiger TV, silver made a perfect 61% retracement from the high we made back on January the 9th. Gold, on the other hand, made a perfect 786 retracement of the high from January 9th. Now, it just seems impossible to me that they would hit these exact ratios to the exact dollar amount, but that's, what has been happening. And so the real key here is all we need to do is to get silver above $17 an ounce, and we're trading around $16.60 right now. Or we need to get gold above the $1,235 to $40 an ounce that Basil talked about at the end of his show. That was all I was able to catch because I was having a hard time getting this computer running just to get up for the show today. So we'll see what's really happening. Now, I'm not sure if the commodity bear markets have stopped going down. We still have tremendous move down in crude oil, which we'll talk about tomorrow at length, because I want to go over, all of the complex in crude oil, because that's gasoline, natural gas, all of the stuff, heating oil, because they've gone to levels, that are really, really cheap. But we got gas here in Tucson at $2.10 a gallon. When we left a couple months ago, it was at $3.08. So you can imagine, people that drive a lot have gotten a real Christmas bonus in their in their expense reports this year, because so far this year, because of the price of low gas. Now, how long will it stay down here, folks? I don't know, but if you remember, in 2008, crude oil went from $143 to $33 a barrel. It dropped $110 a barrel. So it could go even lower than where we are right now. However, you are starting to see signs of a little bit of a potential for the market to hold up. In other words, the downdrafts are a little bit less than the updrafts have been. And we've had, since July, we've had 7 rallies of $4 to $5 a barrel. That's all oil has been able to rally since July. So what you want to watch for is the first time that oil exceeds $5 a barrel. It probably rally about $8, which is 1.618 to $5 a barrel. And then watch for that little pullback, watch for a little ABCD pattern, and that would be the one that I would say, yes, this would be the place where you could test your bottom and see if it's going to be correct or not. We'll have to let the market tell us when it wants to bottom, but right now it certainly doesn't appear that it has a great deal of not a lot of friends at that point, that's for sure. I had one other question that someone had from an email that I got. I had 3 emails this morning about certain things. The other one was about the Tesla, and I will put it up and show you folks what I looked at today in Tesla. It's made a very nice bottoming pattern in Tesla, and I think it's got a chance here for something, at least a pretty good rally from the level that I was looking at early this morning, because it really held up really nicely from the low yesterday. That also was a 786 retracement coming off of the high that we made, or excuse me, the low that we made, back last June. It was one of the weaker stocks that we've had all along, but it did hold the 61% retracement level from that higher level, and that tells us that if these rallies are equal, and we have been going down. Okay, we'll take a little break here. We'll finish up with Tesla when we get back.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped, and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, Nasdaq, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 8 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com, educating investors. This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Okay, we're back, folks, and we are going to talk a little bit here about Tesla because we came down in a nice ABCD formation. We made a retest at the 61% retracement yesterday. That tells us that we should get a little bit of a rally in Tesla of around $20 a share if the market's really bearish. If it's really bullish, it could go to $50 or $60 a share and possibly even a new high ground. But frankly, I think that the market has shaken the tree a little bit because it's shaken the mental part of the tree, not so much the technical part, but it's shaken the mental part. When we go below the lows we made either yesterday or especially the ones on December the 15th, when we go below those, we're going to be looking at a flat-out bear market. And if we break those lows really quickly, we're going to see something that we haven't seen in a long time, since 1987. So watch that very, very closely. Those December 15th lows, those were very, very important for several reasons. One, 3 of the indices were able to make new highs. The New York Stock Exchange Index wasn't, and that could be a major divergence. But if we go below that, that cycle low is really going to cause problems for the bulls. We still have the same problems with debt, and we still have the same problems with advanced decline line. Looks very, very bad. The bulls versus bears is extremely, bearish because of the way that it looks. So those are the things that we're watching here from a technical standpoint. Now, what we've done is we put up the chart of price line. Or I'm going to do that right now. with any luck at all. Give me a second. Oh dear, this is not good. This Ensign program drives me nuts sometimes. There we go. Here, I think we can get the price line chart up now, and we'll take a look at it here with God willing. There it is. We were talking to Charlie just last Thursday, and last Wednesday, and the market, was it Monday? What is today? Oh, we talked to him Monday, and the market has broken down to that 1070 level, which is the 678.6 retracement of the low that we made back on December the 15th. These charts, looking at these, are telling us that we are looking at markets that want to go lower, folks. The reason for that is that these lows that we're making come down too fast. They should be making, higher bottoms, and they are making slightly higher bottoms, but they're coming down too fast. That tells us that we're pretty much, going down. The slope of these lines on just about every chart that you're looking at, there's only a few that don't do that. That tell you that's where you really want to what you really want to be looking at. I apologize if I'm not hitting everything on all cylinders today, because after all the traveling that we did, which was a little over 44,000 miles, you just don't bounce back as fast. I can promise you that. And it was a little bumpy in the skies over the Midwest yesterday, because it was really, really quite tough to get to look at. Okay, we got a caller from Clearwater. David, are you there?
Larry, I am. Welcome back to Arizona.
Oh boy, it's back to we got off the airplane. It was 70 degrees and sunny, and boy, it was really nice to be home. It's not just nice to be home, but the traveling was such a, all of us. I guess being away from the grandkids was a thing that shook us up more than anything else, because we really enjoyed it. That's for sure. What can I do for you, my friend?
Well, being with family is what it's about, anyways.
Amen.
So, anyways, I want to ask you something. You mentioned on last week, and like yourself, I have to travel quite a bit myself, so I'm not able to catch all your broadcasts. But you'd mentioned, and forgive me because the trader's name escapes me. He was a soybean trader back in the 50s and 60s.
Roy Longstreet.
Roy Longstreet, and it was, I think you called it the 135 rising bottoms.
Yes.
Is that essentially, because it's been let me think of this. See if I can say this so I can get my point across, so I can ask an intelligent question about it. I looked at that and I kind of analyzed it, and it seems to me that essentially what we see with the 135 is a lot of times when these Fibonacci sequences start spiraling off and start developing a uptrend, or as far as that goes, a downtrend, but in this case, an uptrend, you have a small ABCD pattern, and once that completes, that tends to become a lot of the times the A to B of a larger ABCD pattern on the way up or on the way down. And in this case, on the way up, is the 135 rising bottoms pattern, is that essentially one completed AB equals CD followed by a following retracement, which then kind of gives a high probability to a rally or an uptrend that tends to follow it? Is that
that's exactly perfectly is what you'd like to see. It's an ABCD pattern is completed, and then you'd think the market would go down to new lows, but it doesn't. It comes in and makes the higher bottom. Fact is, I will repost this here for gold, because you can see it really clearly here. Just give me 1 second, David, to mark these that the folks that go into Tiger TV can see it. But all I did was I met Roy's son Bill first, and I was a big fan of his father, and his father's in his late 80s when I met him, and it was really a pleasure, of course. But they had used this pattern, but they had not used the ratios. And when I showed them the ratios, they went back and did a little bit of work, and they got quite excited about it. But that's really what you're looking at here in the chart that I posted in Tiger TV. You see the ABCD complete, and then you see the pullback, which is a 61% retracement of the X to the D, and that's what makes it so powerful. And that's what, if we get moving in gold, we're gonna see 1260, because this is only the third day up in this move. We could see 1260 either this week or early next week in the gold market. And above 1260, it's going to turn on some lights on Wall Street, because that'll be the first really good rally we've had in the last year. So we'll be watching that very, very closely.
The uncertainty continues in Greece. That'll fuel it further as well.
Is there uncertainty in Greece? I didn't know they had that. I haven't been watching the news or anything.
Yes, my friend, there is. You had his name escapes me, the finance minister from Germany, as well as the prime minister of France, basically telling Greece that, and I think they're bluffing because they can't, the price tag for failure is greater than the price tag of caving into Greece's demands. But there's an election, long story made short, there's an election coming up. I believe it's either the 25th or the 26th of this month. And the polls in Greece are indicating that the anti-austerity mindset of this particular party, who I can't think of at the moment, but long story made short, they're saying, we're not going to play ball with the ECB's demands for austerity. We are a sovereign nation, and we're going to do what we want to do. And then you had the prime minister of France, and I believe it was the finance minister from Germany, saying that, okay, fine, if you do this, we're not going to continue to bail you out. And I think that's helping to put fuel in the bond market right now, especially in the 30-year. If you look at the 30-year, the 10-year is rallying too, but the 30-year has surpassed its high of October 15th when we had that enormous move up.
Sure. And
I think that's what's putting juice in the bond market. So depending on how that handles, I think there's other reasons to be bullish in gold also. But I think if that uncertainty continues, then yeah, we're going to see significantly higher prices in gold, and I think we're going to see significantly lower equity prices, but I don't expect that to happen. I think what we're seeing is just some saber rattling because at the end of the day, I don't think Greece is going to blow their deal, and I think it'll be a negotiated settlement. But I don't have tomorrow's newspaper, obviously, but that's kind of my expectation based on what we've seen in the past. If I could, switching over to the S&P, I'm just making a prediction. Obviously, I have no way whatsoever of knowing this, but for some reason, I just kind of sense that we're going to see another 5-point reverse wave happen. I think we're going to rally up. We're going to go higher than the December 29th high of 2093 on the cash S&P, and then it's going to make a lower low past the December 16th low, and then make one last push up. And my expectation is that between a lot of things we've been seeing, between the higher dollar, which will put price earnings pressures on the major corporations, and I think we're going to see I'm not suggesting a crash, but what I think we're going to see is one heck of a short opportunity, probably in the next let's say 2 to 3 months, something like that, as we go into the summer.
Well,
so
that's certainly the way this month. That's a heck of a prediction because you have a lot of volatility built into that prediction, and I wouldn't be surprised to see it because we didn't have any volatility during 2014. Being an historic year where we went, I think 289 days without a 4-day correction, and we finally got it into January. So we'll have to you have to give it respect. The market that's been up here this long, you certainly have to. I do know that December 15th, if we go below that's going to really trigger something. And the other thing, David, that I think is important is that it was 1987. That was 26 years ago. 24 years ago. 25 years ago, where we had the big crash from the October 16th to the 19th. And, it's been, most of these people have not been involved in one of these things. And since this market has broken every single record that it's, since the bottom in 09, I wouldn't be surprised if we have another one, just because of the fact that this market, it is so strong, it ought to have some type of, a plastic stamp on it to say, look, it's not as easy as you might think. But it'll probably be a big buy. It'll probably be a big buying opportunity, much like it was in 1987. That was the best buying opportunity since 1982. So we don't really know. We live in a great country. Look what else is going on in the world. No wonder people want to live here. Golly, this is great. You become an illegal. When you're an illegal here, they give you Social Security, free medical benefits, and everything else. You do that in another country, they either execute you or deport you really quickly. We don't do that here.
No, that's definitely true. I'll tell you, you talk about the crash on 87. I was raised by a father who traded the markets quite heavily, and back when I was a kid, there wasn't the computerized trading back in the in the 80s. So you would have to be at the call Merrill Lynch or your stockbroker, that kind of thing, to trade. He didn't work for Merrill Lynch, but he traded the markets heavily. Forced me as a kid to read the Wall Street Journal. Not too many 12, 13-year-old kids were forced to read the Wall Street Journal growing up, but I was. And the reason why that day is seared into my brain.
We'll have to wait and see if we get that. I think the real key is if a crash is coming, it usually tell you that that's what it's doing, because in 1987, it was really telegraphing that it wanted to do that, because it made a bottom on the 26th of September, rallied into October the 2nd, and then it closed really badly on the 16th of October, that Friday, taking out the low of September 26th, and then gap down 200 points, and then that was it. And I just don't want to go through that again. I mean, and I was on the right side of the market, and I don't want to go through that again. So
yeah, no, and I'm not suggesting that we're going to have a crash along.
Are you still there, David?
Yeah, I'm here.
Oh,
yes, I am.
We finally lost David. Sorry about that. Okay, we got coming up for another break here, and then we have one other question about a commodity, and then we will move on to some more stocks here. We had a question about soybeans, and I will put, you know what I want to do? I can hold that question on soybeans for tomorrow's show, because what I wanted to do, which I think is actually more important, is to take a look at what's happening to the interest rate market. The 10-year notes yesterday made a perfect Gartley pattern. They went up to the 129 level. We're trading at 128.13 right now. There was a beautiful ABCD pattern that started on December the 1st, so it took a month to form. It was really symmetrical, a number of days up. And the AB leg was equal to the CD leg. You had a point a little above the 0.618, hit the exact 707 number during the fast market. The bonds did take out the October highs, which I didn't think they had a chance of doing that. But the note market is far, far bigger than the rest of the market. But if you'll look at this 10-year note chart on the long-term weekly basis, you'll see that we've been in a really pronounced downtrend since 2012, and we've had lower highs in 2013, and now we're had a lower high in 2014, and also we've had a lower high in 2015. Well, what's also interesting about this chart, it also brings out that 135 rising bottom pattern that Roy Longstreet talked about. It did it twice, once back in 2009, 2010, and 2011, and it did again during 2013 and 2014. So this is a very important, pattern to watch, when you're looking for a bottom, or on the converse side, if you're looking, for a top to form in. You want to sell the lower tops and buy the higher bottoms. That's really the best way to use pattern recognition from the standpoint of, keeping your risks as small as possible. Now, I wanted to switch over to the bond market here for just a second, because that market really went ballistic here yesterday. It took out the October highs, as I mentioned before. And there we go. We should be okay now. We'll get that up and we'll take a look at it here. And this was a really unusual move because of the fact that it did do that. And if you'll give me a second, we'll put this in. We completed another butterfly. Oh, I'm going to update these charts. I'm afraid that I'm going to have data in here that might be missing. I don't think we're okay because I tried to do it.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. EverBank is a member FDIC and equal housing lender.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Up next, the Diagnostics Trading Hour with Darrell Martin here on TFNN.
Okay, we're back, folks, and I've posted the chart of the euro, the long-term weekly chart of the euro here to let you take a look at it. We made a bottom down in August of 2000. That's when my grandson was born, and we made a high in 2008, and now we're approaching the 61% retracement in the euro. That would come in at around 113. As you can see on this chart, we have several A, B, C, D patterns that measure into that area. This has been a very protracted downswing in the euro that started, way back in, when was it? It was back in March of 2014 when we started down. So we've been down 9 months without a significant correction at all. I mean, nothing at all. And, it looks like we're heading towards the 113 level. There should be minor support coming in around 117, but frankly, this has all the earmarks of a market that wants to go to this level. That's basically what it looks like from a technical basis. The 61% retracement, as I mentioned before, comes in at 113. we have the long-term ABCD comes in at 109, and we have the shorter ABCD over the last 2 years comes in at 111. So somewhere in that zone here between 111 and 109 is I would expect the euro to make, very good support. But hey, that's just my sophisticated guess, folks. Tomorrow's show, we're going to be talking about the oil complex, and it's massacred everything. The good part about these numbers is, once they go below these 618 or 786 numbers, it gives you a high probability that they're going to the next level. So that's one advantage of using pattern recognition that helps you trade with the trend, that, once it breaks a significant low, that it's most probably going, go to the next level. And that's what we're going to be talking about tomorrow in the oil complex. We're going to have Rich Anderson as our guest tomorrow to talk a little bit about the grain markets, because we've had some, $1 a break bushel in wheat since we talked. And he'll also talk to us about some of the things that are happening with the currencies and treasury notes and treasury bonds. So try not to miss that show. He's always a fun guest to look at, and he'll also bring in little things about the meats and grains and stuff. So we'll have Rich Anderson on tomorrow for the commodity show. Now the other cross rate that looks really interesting here is the Japanese yen versus the US dollar. For some reason, and I guess it's because of the weakness in the Nikkei versus the currency itself, but the collapse that we've had in the euro and the British pound and the Australian dollar, this did not happen with the dollar yen. That actually strengthened, and it's held above below the 61% retracement at that 121 level. We got all the way down to 118 and change. So that's telling us that there are some really interesting things happening. In fact, the first chart that I posted into Tiger TV today was the one from the yen dollar, showing that had some strength, weakness versus let's try it again, Larry. Strength versus the dollar versus weakness everywhere else. So it's going to be fun to watch that one unfold too. The Nikkei's had a major top form at that 3 drive to a pattern on the weekly basis that we've talked about here several times in the Tiger chat room here. And folks, that's one thing. If you got a New Year's resolution and you trade alone, you'd like to have some help, the TFNN chat room and trading room is a really good place to not only go and get some good ideas and some good trades, but you'll learn a whole lot, because folks at TFNN, Tom O'Brien and his group, spend a lot of time giving you top quality education and information to help you make yourself a better trader. And I did that because I wanted to say it. I wasn't asked to say it at all, because I really feel strongly that it is a good place to learn some things about trading. There's some real smart folks there that will lead you to the promised land. And specifically, I have to give my hats off to Basil, because he did such a splendid job all through the bull market.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.